Hey guys, Leon here. Welcome to my next video in my Investing Basics series where I teach you how to invest. Today we'll be talking about the balance sheet. I think this is one of the most important concepts in investing that you absolutely have to know. There are many people that kind of just brushed it off and they lost tons of money. I think it is one of the most underemphasized concepts that I've seen in the YouTube investment community. First, we'll start off by talking about a real-world example to kind of illustrate and show you how it works. Then we'll kind of go into what it means to make money in real estate that you see all over the place in YouTube. Then we'll talk about how to spot scammers and how we can relate that to your personal finances. And then we'll kind of switch it up a bit and look at a corporation's balance sheet, and we will look at whether or not it is a good investment to buy. All right, let's get into it.
All right, so meet Joe. He is in the market to buy a house, and he's looking for houses. Let's say that this is a neighborhood, and each one of these squares is a house in a neighborhood. He notices that all of these houses are worth $1.4 million, except for this one. It is worth $1 million. So he's like, hey, this is an opportunity. I'm going to buy this house. Unfortunately, he doesn't have $1 million. He only has $250,000. So he goes to the bank. He asks, hey, can I borrow $750,000? I will promise to pay it back. And in there, I'll also include interest. The bank says, well, hey, how can we stack this more in our favor? Well, why don't we put in the terms in this IOU collateral that the house has to be put up as collateral. Collateral essentially means that in the event that Joe would not be able to pay back the loan, that the bank could take the house. So Joe says, sure, we can do that. Joe gives the IOU to the bank. Joe takes that money and he buys the house. Great. He gets the keys to his house. Let's just kind of draw that here so we can kind of visualize what's going on. So this is his house. It is worth $1 million. So on the left, it shows Joe's house. On the right, we're going to show how did he pay for that house. So Joe owes $750,000 to the bank. So what does Joe own? Joe owns $250,000 on that house because that's what he put down. Each month, Joe pays the mortgage, and then the amount that he owns becomes more and more, and the amount that he owes is less and less. Let's just kind of change these terms. Instead of calling that what Joe owns, we can call that equity. Instead of saying what Joe owes, let's call that his debt. The term that accountants like to use for debt is actually liability. Liability. Instead of calling it his house, why don't we call it his asset? This is basically the balance sheet of his house. A balance sheet is also written as mathematically, it's assets equal liabilities plus equity. It's called a balance sheet because both sides of the equal sign have to be in balance. This equation has to be true because the purpose is to show how his asset was financed. Financed meaning how he paid for it. We're talking about personal finance right now, but if you apply this term to corporate finance, this is actually called capital structure. Why do we call it capital structure? Because let's say that capital is another term for assets. So this is a way to describe the structure of how the assets were funded, making it capital structure. You want to know how much of it was financed by debt and how much of it was financed by equity. So let's imagine a recession happens, and unfortunately people lose their jobs, they can't afford their mortgage payments, evictions happen, So the housing supply increases, demand drops, and then housing prices fall. In this neighborhood, it fell by half. So let's say that everything fell by half. The house is now worth $500,000. The amount that Joe owes the bank does not change because they gave him a loan. So the house is now worth $500,000. Splitting this basically in half, and all of this becomes no longer an asset. His asset dropped in value to $500,000, and the liability, in other words, the debt that he owes the bank, is still $750,000. He can't change that because he made an agreement with the bank that he was going to pay that, so he has to honor that. So we need to find out how much equity he has on the house. Well, if you go back to your equation, all you have to do is solve for equity. Right? This is basically just algebra, okay? So you solve for equity. He doesn't own anything on the house anymore. He has no equity. In fact, not only does he not have equity, he has to pay $250,000 before he can even have any equity on the house. So he has no ownership on the house. Well, Joe looks at this and he says, "Hey, this is a terrible deal. This is terrible. I think I'm just going to walk away, and this is a terrible deal for me, and I'd rather just walk away." So he walks away, and the bank says, whoa, hold on a second. Don't you remember? We get the house as collateral. So the bank can take the house, but they say to Joe, hey, hold on. Let's not be so hasty. Tell you what, why don't we work out a deal? And so sometimes the bank will work out a deal if this happens, and he says to Joe, why don't you sell the house on the market for whatever you can get, and we will accept whatever the house goes for, and we'll just take the loss, and we'll also just pocket your $250K at the same time, but we made a loss, so I think it's balanced. If Joe accepts that, that's called a short sale. If Joe says, nah, I don't want to do that, I'm walking away, see ya, and the bank just takes the house and then the bank has to put it on the market, that's called a foreclosure. So let's say you come along, and you, being the savvy investor because you watch my channel and my videos, you know how to work with money and how it can work for you, so you decide it's a good time to buy because you know that the market will eventually recover. So you think to yourself, hey, why don't I just buy this house and I can make some money off of it? You want to put $100,000 down, and you want to borrow $400,000 from the bank, okay, so that you can get the house for $500K because it's half off due to the whole recession business. The bank agrees, and then you end up buying the house. So let's look at how your balance sheet looks. Over here, remember, this is your asset, and it is worth $500,000, and you owe the bank $400,000. So that means that you own $100,000 on the house. Before we go any further, we didn't kind of clarify, why is this house worth, before the recession it was worth $1 million, and all the other houses at that time were worth $1.4 million, and after the recession, why is it that this house is worth less than everything else on the block? So the reason that house is worth $500,000 instead of $700,000 is because it is what we call distressed property. It has problems such as no carpet, no toilets, cabinets destroyed. The cabinets in the kitchen were destroyed, paint problems, and it's dated and it needs remodeling. So you look at that and then you're thinking to yourself, well, you talk with a contractor and you say, hey, you know what, all this probably cost me $50K and I can get that to turn that $500,000 property to a $700,000 property, just like all of its neighbors. See, all the neighbors are 700 and it's worth 500. So you can get it on par, just need to fix it up. So you end up fixing it up. After you fix it up, now the house is worth 700,000, and so you basically have an additional 200,000 on the asset. Because it's a balance sheet, then we have to look on the other side. We have to balance this out. You had to spend 50,000 on repair, but that's actually equity. And so how much free equity did you gain? You actually gained $150,000 in free equity. Okay, great. So it doesn't stop there. Because you watch my videos and you know how this works. You wait 4 to 5 years and the recession's over, right? And the prices are back to what they were before. And so, really what happened was you fix this up to 700K, and then this actually becomes the same value as all of the neighbors, right? In order to recognize that, just put that here. And this is another 700,000 that this property is worth. How do you balance on the other side? Well, this is also free equity. That's awesome. You made a bunch of money by fixing up a distressed property during a recession, and now that everything is recovered, it's back to market value, and now you gained a bunch of money from that. Good job. So a lot of people actually made money this way. During the 2008 recession, housing prices fell dramatically, and the people who had money on hand were able to buy up properties and become rich from doing this. We've kind of explored the balance sheet a little bit and kind of looked at it inside and out, so you're probably a pro on that now. Now, I wanted to kind of reevaluate a few things that we see on YouTube. Oftentimes there are get-rich-quick schemes. Maybe people say, I control an $8 million real estate portfolio. Well, let's kind of look at that, because since we understand a balance sheet now, when you say $8 million, what does that mean? Does that mean that your assets are $8 million? Does that mean your liabilities are $7.9 million? And then you have $100,000 in equity? What does that mean? So you can see how a lot of the things that people say can be misleading. You really have to understand their cost structure or capital structure that we learned if this is a corporation. I hope this kind of helps you out when people start bragging about how much money they control. Okay, now let's kind of go to in personal finance. When people buy expensive items, whether it's to impress others or to feel good about themselves, let's just make a list of things that are really expensive. Let's say like luxury handbags. You can also say, cars. Let's say like really expensive cars, boats, really luxury furniture. And a lot of people, when people buy this, sometimes they argue, well, it's an investment because it's I'm investing in assets, Well, some people would argue that, after 1 year, the price may go down. In my opinion, that's called a depreciating asset because it is depreciating in value. Let's say that if a lot of people actually financed these things through a cost structure like this, with most of their balance sheet being more towards the debt side, then that could be a problem. Let's say that this individual lost their job and they could no longer pay this debt. How long would it take for them to be able to resist bankruptcy, in terms of being able to pay off all this debt using equity. How long would that take? This term is actually called solvency. Solvency is the ability to pay your debts and not go into bankruptcy. The more solvent you are, the more financially healthy you are. You may have heard of the term leverage. What is leverage? I'll show you through a picture. This is what I call leverage. This portion here is called leverage. And when your cost structure looks like this, I call that over-leveraged. These concepts in balance sheets can apply to both personal finance, and they can also apply in corporate finance, as we mentioned before. So now that you have a pretty good understanding of a balance sheet, why don't we look at some actual corporate balance sheets and decide whether or not that company has enough solvency to be worth investing in. All right, so let's analyze a real-world balance sheet. I won't tell you what company this is just yet because I don't want to bias you, but let's do an objective evaluation of the balance sheet and determine, is this a company worth investing in or not? So remember, balance sheet is always going to be assets equals liabilities plus shareholder equity, right? So let's orient ourselves. Over here you have assets, then down here you have liabilities and stockholder equity. And everything on the left here is basically going to be ordered most liquid to least liquid. And liquidity is a measurement of how easily that asset is turned into cash. So that's why obviously up here you have cash itself, then you have things like cash equivalents, then you go down here which are receivables. Receivables means debt that you own that other companies are going to pay this company. And then down here you have things like plant, property, equipment, which are very difficult to turn to cash. A balance sheet actually has a ton of useful information, and we can't possibly go over all that stuff right now, but we'll kind of just go over the things we've talked about so far. So remember, we kind of built a balance sheet visually and conceptually. We kind of drew this little box, and then we go over here, and then on the left you have your assets, right? And if we look over here, total assets is going to be, right, 25,842. Now remember that this thing says in millions, so you basically have to add 6 zeros. So that comes out to be 25 billion, okay? And then now we need to find out how many liabilities are in this company. So we just kind of scroll down, and then you will see total liabilities right here, and it is this. Well, what do we have here? 24 billion. So if this is 25 billion, this is 24 billion, then that means that our shareholder equity is going to be something along the lines about that much. If we were to estimate, I'd say between 1 and 2 billion. Is that right? Because 25 billion minus 24 billion would be around 1 billion, but we kind of round it up. So let's kind of go down here and see if that's accurate. What do we have here? Total stockholder equity, that comes out to be around 1.5 billion. So this is an example of a company that is financed mostly by debt and doesn't have much ownership in its assets. So I also want to point out that this number up here, which is the total assets, should equal this number over here. Why? Because remember, assets equals liabilities plus shareholder equity. This is the company that we're talking about. You may have heard it in the headlines, you may have not. This is a company that was on the news, that many people on Robinhood who really don't know how to analyze financial statements had kind of dumped all their money into this stock because it was cheap. Well, it's cheap because nobody wants it. So, a lot of the what they were talking about was that people who don't know what they're doing were buying this stock. And yes, if you looked at this balance sheet, you could see how terrible it is. You can see right here, this is not a company that is in good financial health. And they even told the public that they were going bankrupt, yet people bought it, and the only explanation was that they don't know what they're doing. So don't let that be you. All right, so we have another balance sheet here. Take a look at assets, liabilities, and stockholder equity, and then take a look at total assets. That'd be 300. Let's kind of just draw it conceptually. 301, and then coming down here. Then if you look at the total liabilities, right? Total liabilities, that is 183. So probably about like this, 183. And then over here, you have 118. Now, equity is a lot better in this company, but there's more to it than that. And we can't really go into all the details in this video, but I'll just kind of give you an example. For example, you really want to look at current assets, and so, this number is really important. And then, rather than looking at all liabilities, you want to look mostly at current liabilities, because that's stuff that is going to mature a lot sooner. But we'll kind of go into that in another video. For now, I just wanted to illustrate the overall picture of a balance sheet. Does this look like a good balance sheet? Yes, actually. Not only is their equity is pretty good, but more of their current short-term liquid assets are pretty good compared to their current liabilities. Actually, almost double. Guess what company this is? This is Microsoft. They're one of the companies in the United States that has a AAA balance sheet, basically the best rating you can get.
If you understood today's concept about the balance sheet, congratulations. You now know more than 50% or more than the people investing on Robinhood right now. Thank you so much for watching today. Please leave a comment below, like, subscribe, or share with a friend, and I will see you in our next video.